this sort of middle ground is probably where we might see some squeezes, because investors, particularly when thinking about broad-based asset allocation, are going to want to I know this is effectively how you guys think about portfolios, looking at sort of core exposures in a low-cost beta way, couple that with satellites on either the true active side or a theme or a sector or industry that's going to add some resiliency or outperformance in a portfolio.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinion only, and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Talley Leger. I am the Chief Market Strategist of the Wealth Consulting Group, and I'm so pleased to be joined by my longtime friend and ex-colleague, Dave Mazza, who is the CEO of Roundhill Investments. Dave, welcome to the show.
Hey, it's so good to be here with you. Thank you for having me.
100%. Well, in fairness to the audience, we actually just saw each other in Vegas at Exchange. And it's funny, we were joking because we had your wife, Allison, on the pod. So we get the Mazza twofer. How about that?
Yeah, no, it's not every day that you get the both of us. Allison is a dynamo, so she probably will end up doing a better job than I do today. But thanks everyone for inviting me on as well to share the other half of the Mazza crew.
The dynamic duo, 100% now, 50-50. So I have to also tell the audience and share a little bit about our story, because we go back a ways, man. I want to say more recently at Oppenheimer Funds, where you ran the ETF group there. Geez, was that 2016?
Yeah, no, I was right around then. So we were there for a few years together. You were, leading up equity strategy. I was leading up the ETF group at the time, and just we always were bouncing ideas off of each other, particularly sort of your insights in the market, pairing those with some of my perspectives as well. So that was a great experience. But to your point, we actually go back even further than that, which is also kind of fun.
Yeah, we've got that kind of common Boston DNA. We both went to school there, rival schools, in fairness, BU here, Boston College there. But I guess we first overlapped officially in the industry at a David Kotok conference. I remember this pretty well, except the year it kind of escapes me. I'm getting old. I won't speak for you, but was that like the 2012 to 14 range, I want to say?
It had to have been. I was still at State Street at the time, leading up their ETF strategy and research team. Right. And that was fun, right? Because you were developing models that actually were using the sector ETFs as an input. And so that was actually a really fun conference where you were kind of sharing perspectives on sort of how the models were being built. And then I was kind of talking about the tools and how they're actually implemented and what the end exposures in those actually are, and why they're still to this day, great tools for investors looking to express a view on sectors.
Well, what a great experience for all of us. I remember that dog and pony show. We wrote a book, and then we did the signings, and we gathered.
That's right.
And we had you up there talking about spider sector ETFs, and yeah, spot on. And so here we are, full circle. So I'm on the wealth management side. We run financial plans. Think of us as the contractors in the ETF rush, if you will. And we were both very early adopters of these passive vehicles and instruments. And now you're on the innovator and development side of things. So think of the picks and shovels of the same rush. So maybe we should get into that a little bit. But before we get into the product side, maybe we should kind of break the ice with some market questions. So, I've been talking about this, and I know you're very well aware. The S&P 500 has famously fallen below its 200-day moving average. You know what I'm going to say? I think that's a buying opportunity, not a selling opportunity. But I wanted to hear your perspective, and what do you think amidst all the chaos? You think the S&P was down 20%, but it's still maybe 6% from its all-time highs. What are you seeing, and what are your thoughts here?
Yeah, maybe I'll start with that kind of latter part of your comment first, because we as investors really in the most recent years have been so accustomed toward either buying the dip in a very, very swift fashion, or the Federal Reserve bailing us out, now Trump taco, Trump put, whatever kind of term de jour you want to use. What feels a little bit different this time around, of course, is the conflict that we're seeing is just dominated by headlines. So really the last few weeks in the market have not been, at least from my perspective, truly fundamentally driven at all. And maybe that's quite logical when you have pretty aggressive rhetoric from both sides of the conflict, paired with troop buildups, satellite images showing no ships going through the Strait of Hormuz, of course, military actions happening on an overnight basis, and investors are waking up to all this. But we also have to put it in the context of just the rip-roaring rally that we saw from Liberation Day. Then also, even before we came into this, I do think investors were beginning to be significantly more discerning about the AI trade, which had powered really markets forward for the better part of the last few years. And names like NVIDIA and other Magnificent Seven names really kind of stalled out about 6 months ago, not making new highs relative to the broader market. But when there are such large weights in the market themselves, even with a rotation trade happening, with the energy sector only up 3%, it's only 3% of the broader index. Even if it's up 30% on a year-to-date basis, it's difficult to see the market being buoyed, when the generals, if you will, are kind of taking it on the chin for the time being.
Yeah. Well, so I guess what I'm hearing from you is that this is perhaps the pause that refreshes as opposed to the start of something sinister. And I think, yes, in fairness, you have to acknowledge we're responsible stewards of capital. So we have several operating scenarios, right? And so we were fully aware of the headwinds and the downside risks, and we're being challenged and being greeted by that head on. But while there are some similarities, right? I guess it would be the perkiness here, a little bit of inflation, and rate cuts being priced out of the futures market, and oil prices to what we experienced in 2022, right? That's the doomsday scenario. That was a bear market for stocks, and a very uncomfortable environment for all investors, not just equity investors. But I would say one of the key differences this time around is a potential positive supply shock, not the negative one that has sent all the fears that have sent the WTI crude oil price north of $100. It's calmed back down now here, I think, as the news continues to improve surrounding the war. But I'm going to say it again, the U.S., very different fundamental underlying conditions here compared to, say, Europe or Asia. The reasons for Brent, the global benchmark, being as high as it is, makes absolute sense in that context. But supply here in the EIA, they actually calculate supply and disposition for our crude oil product, and it is at a record. And so when you compare the supply concept with the price, there's a massive divergence that is unsustainable. And I think the price of oil here at home just wants to calm back down. And that would, to me, be a massive tailwind for stocks and risk assets in general. Is it? What do you think? Is that an oversimplification?
No, I actually think it's quite accurate. But you packed a lot into that answer that I want to sort of expand on a bit. 2022, let's just spend a moment on that. That actually, if I think about sort of, my investment career, which includes the global financial crisis like yours, obviously that was tremendously scary. In many ways, closer to a depression than a recession. Equity markets were absolutely hammered. But 2022 was almost more painful in some ways because it was this kind of almost rolling recession, at least when it comes to stocks. And so there was like various sectors and industries that were kind of seeing these bear markets then play out, and you almost had nowhere to hide. Now, some of that was, to your point, coupled with sort of the spike in energy prices. Now, and then, of course, what the Federal Reserve was doing. Where the analogies are similar is, when you see, look back to Chair Powell's most recent press conference, it does feel as though the Fed is a little bit boxed in here. Whether we set aside political viewpoints for anything, that what the data shows is a labor market that's not falling off a cliff, but also not incredibly robust, inflation not cooperating anywhere near to the 2% handle that the Fed has said they're targeting. Whether they actually are or not is a bit of a different question. And so does that mean we're actually going to see the number of rate cuts that were projected, at least heading into this year? Likely not. But I would also argue that perhaps the market itself doesn't necessarily need that many rate cuts because it means that the economy, particularly corporate earnings, are holding in quite steady, which I think is actually fascinating. Is even since the start of the Iran war conflict, analyst estimate revisions broadly have actually increased.
Yes.
They have not gone down, which I think tells me fundamentally that, to your kind of earlier comment, this is not necessary. Maybe this is actually a healthy resetting of expectations. There certainly are areas, and I know you've been talking about this. Software is a great example where it is totally a throw the baby out with the bathwater situation. There certainly should be concerns about what AI disruption is going to do to many of those companies, but not all of them. Some of them could actually be beneficiaries. And so, the way at least I've been trained or think about it is that in horizons like this, markets like this, you have to kind of think about your time horizon.
Yes.
So you either, if you are a trader, and I know that's not necessarily what we're talking about here, then you probably need to shorten it, right? Because looking at intermediate time periods, it's probably pretty hard to see where things are going to land, especially when you're in a rhetoric-driven market. But it's also an opportunity to lengthen those horizons. If you're entering or looking for opportunities, just using the S&P 500 as example, while valuations historically are not cheap, using arguably any measure, they're also not nearly as expensive as they were not that too long ago. And so when you couple that actually with a still positive earnings story, the market itself, particularly falling below, which was an important technical indicator, the 200-day that many people in trend following models follow, it may be poised actually to see a significant return. Look at what's happened in the last 3 Mondays. The market, and some of this is driven by social posts and things of this nature, but the market still, I think, wants to, if you think about the market as kind of a machine, wants to move higher. But at the same time, it's logical. Investors do need to think about different risk premia that they're going to assign to where earnings may or may not come in when this conflict does not necessarily have a certain ending date or really a clear path toward resolution, albeit the fact that we have seen much more positive news on that front, which is, I think one of the reasons why oil, to your points, has calmed down significantly, including Brent. That doesn't change it overnight, but it does, I think, maybe price out some of those worst case scenarios, like a sustained $150, $160 price of oil, which certainly would be incredibly disruptive to the broader economic story.
Yeah, I mean, I would say, look, and this is to your point. I think neither of us is a geopolitical strategist, and so I personally have no spec insight on the war. But for what it's worth, we have been seeing some flashes and headlines from both sides, kind of laying out their conditions now for ending the war. So perhaps the worst of the or bad news is behind us. We talked about some of the similarities, and we understand those geopolitical conflict now versus 2022, spiking oil prices and hawkish pause from the Fed. But consider all the differences, right? Why this is 2026, not 2020. So inflation itself back then was north of 8%. It's below 3%. Look at headline CPI. That's a big difference. Even the trajectory of the federal funds rate itself, it was coming up off the zero lower bound back then, and now it's been coming down. And I suspect by the time this is over that it would continue its trajectory. We'll have to wait and see on that score. But another one, to your point, earnings are significantly higher today than they were back then. So if you consider the PE to earnings growth rate, it's actually cheap, this market, on that PEG ratio basis, which I think is kind of lost in the narrative. I like to kind of bring that back in every once in a while. But maybe that's a good kind of transition to the tech trade, because I think we're both chomping at the bit on that one. You're famous, so I have to say this. This is your shameless plug to help you out. So you're famous for the Magnificent Seven ETF. And look, I think the reality is, and I follow those earnings, Mag 7 earnings continue to surprise on the upside. And there's a huge delta between those earnings and the earnings of the rest of the market for 493. And so understandably, Mag 7 currently out of favor with investors. But what do you think is in store, I guess, for the tech trade in general? Personally, given the robust fundamentals, just take your pick, whether it's headline, revenues, margins, earnings, they're all top of the market. It's difficult for us to be bearish on tech in general. And I still think that tech has a very important role to play, and this is what I've been saying, tech itself should enable a broader market. And, everything's on pause for now, with the exception of maybe the energy sector for the reasons that we've been discussing. But what do you think is in store for tech and maybe the Mag 7 in particular?
Yeah, well, sort of to kind of the conversation we talked about, these kind of rolling issues that we've seen. The Magnificent Seven is, already had already hit correction territory. They sort of kind of almost led the sell-off before we even got to the conflict. And a lot of the reasons why I believe that we're seeing some of the de-risking in the Magnificent Seven trade is this concern about, even to the points that I would totally agree with, the difference between revenue growth, earnings growth versus the Mag 7 493 still, even though the gap has narrowed a bit, is astronomical. The revenue numbers that these companies are printing. I think investors, we've forgotten just how big these numbers are. Because, and one of the reasons why the revenue is so strong is, while it's 7 stocks, it's hundreds of companies. Even look at Alphabet, just the number of companies that they operate and make revenue from. They're not just moonshots anymore like Waymo in their broader portfolio. And so they have a lot to offer to investors. I think the reality is, though, is investors are now kind of beginning to say, hold on, tech was historically high margin, low assets, very, very asset light. Now with the buildup, especially with the hyperscaler names in that group, where they're introducing a much greater number of CapEx, are they able to fund it from their free cash flow, or do they have to go raise debt to do so? And we've seen some of that. And so I think the market has kind of questioned that. But once we sort of clear the air from the Iran conflict, we'll then start refocusing, or maybe we'll have to do it while it's happening. But earnings season is not that far away. And
right.
What we're going to see is more great earnings from these companies. And I do believe that could be an opportunity for investors to actually re-step into those names. I also, generally agree with you. We've also, in regards to the point of sort of, tech being probably a cornerstone, of many portfolios, still, if you own a broader index, you're going to own a lot of tech anyway today. We've gotten into this environment, and some of it I think is because it makes for good news stories, that it's an either or, right? Either you're loaded up on tech and that's all you care about, or you have to do a rotation and load up on small caps, emerging markets, Europe, what have you. I don't know how or when that sort of became the thinking or the market's thinking, but it's certainly not beneficial to long-term portfolios to have that perspective. So I actually think there's opportunities here now in tech. Look at, if we want to pick on two companies, and nothing wrong with ExxonMobil when I say this, nothing, not that NVIDIA should be the largest position of everyone's portfolio, but it makes me wonder, why is the price to earnings multiple for Exxon today higher than NVIDIA? That I think in and of itself kind of tells you the fear that investors have had about AI, and now sort of this reloading into what was an underowned sector, maybe for good reason because of some of the issues that we've had on the energy side. So still, I think we're going to be seeing the amount of CapEx that we've already been forecast to spend in 2026, it's going to a few places, GPUs, memory chips, storage names. So I don't think investors should all of a sudden sort of totally forget about just the amount of revenue that's being thrown, particularly at these major tech companies.
Yeah. Well, so just again, for context and for the audience benefit, we run diversified portfolios because we're trying to help people save for their retirements. And so, yeah, we own, it's not just about tech. We also own small caps and international. And it's interesting, while small caps aren't defensive, they're actually down the least compared to some of the other major categories like the Mag 7, which you mentioned in the NASDAQ. And so, in fact, I put out some thought leadership content on that score to try and encourage investors to think more holistically and use small caps as a way to mitigate the concentration or tech risk that had been embedded in the market. But I wanted to ask you, given how in our careers, all right, and we talk about this a lot on the pod, the growing interest or share of passive investing. And we're talking about exchange traded funds, these passive instruments and vehicles crowding out active, right? This is a secular or structural trend, and we like to call it the liberalization of capital markets or leveling of the playing field. But I wanted to ask you, given this now changed market structure, have ETFs, and you're the issuer here, so you're the expert, have they become the marginal price, especially in mega cap tech, which we were just talking about?
Yeah, so it's fascinating. Maybe I'll share a little kind of story. I actually got into ETFs by accident, although now I've made a career out of it. So back when I was in my early part of my career at State Street, working on as an analyst assistant portfolio manager in enhanced indexing. And for the audience benefit, enhanced indexing is not nearly as popular as it was in 2005. But literally it means taking an index and making small tilts, overweights and underweights, all quantitatively managed using very kind of simple to understand metrics, but at the time they were complicated. Price to book, price to earnings, high quality, high free cash flow, strong analyst revisions, and then slightly overweighting the names or industries that were more positive on those metrics and slightly decreasing. But what happened was there was actually, before the global financial crisis, there was an event that happened in August '07 where it was called the quant crash. And many quantitative hedge funds, enhanced indexers, turned out everyone was doing the same thing, using the same risk models. And people, someone got tapped on the shoulder and said, we're going to pull your capital. And it literally splintered that entire market. So the PMs that I worked for, my bosses at the time, said, Dave, can you do some research to say, like, are ETFs causing this? So I actually wrote a white paper that was published in an academic journal called Do ETFs Increase Correlations? And to cut to the chase when it comes to the ETF side, the person leading Spider ETFs pulled me into their office and basically said, in not so kind words, what the heck is this kid writing about ETFs for? Do you want to come work upstairs? Do you want to come work here and do this kind of research? And so literally, very on State Street, very on sort of corporate culture, they literally pulled me out of one team and pulled me into another to then lead the ETF research effort. But what this paper said, and this is back in 2011, was that actually ETFs do not cause, and I've seen this data updated, I look at it periodically, do not necessarily cause an increase in correlations, meaning the co-movement of stocks together. So the rise of passive investing has not necessarily changed it. But I will add some kind of interesting points here. There are smaller markets. Let's say there was a Peruvian, this is my favorite example, a Peruvian small cap REIT ETF. And it turned out that all of a sudden people wanted to be in this, and it was a $20 billion ETF. Well, those funds don't trade over, those underlying securities don't trade that much. So they would be the marginal price setter in a market like that. When it comes to sort of the broader US equity market with the number of participants in it, ETFs are not necessarily the price setter on a daily basis. However, the rise of sort of index investing, particularly when it comes to in people's 401ks, target date funds, there is just generally a bid on indexes, on stocks that we have not seen historically. So that is a change. And then when you couple the fact that there has been a broad-based move away from active management where people are selecting securities that they believe are going to outperform over whatever time period that manager has, and people are just saying, I can just access the market at sub 5 basis points for almost free in many cases. People are kind of defaulting to that, whether it's retail, financial advisors, institutional investors. So there is certainly, again, over the longer term, there is more sort of co-movement happening because people are just kind of all generally on a daily basis and things like 401ks kind of buying the market. So that certainly is, I will acknowledge that certainly is a change, but it doesn't necessarily mean on a daily basis active managers can't outperform anymore simply because there's been a rise of passive.
Well, I would agree. In our results, when we look at our model portfolios every week, we have a quant stock selection model that's our number one performer, and it's active and it's based on five factors. But, I don't want to toot our own horn too much, but it's fascinating how things evolve without really changing. So you're talking about active indexing at one point, then I think it was known as smart beta. And now that it's active ETF. So it's really just kind of old wine in new bottles, wouldn't you say?
Well, I think the industry is very good, whether on purpose or almost by default, of sort of like repackaging ideas. You're absolutely right. Smart beta factor investing, that's existed. Actually, the first ever index created before even sort of the Vanguard and the Bogle story kind of took over and created passive, was actually an enhanced index, a factor-based index in the early 70s, created by Wells Fargo when they actually had kind of a quantitative portfolio management team. So, but now, that term then became smart beta, where people were just kind of taking tilts that historically over very long time periods have generally led to outperformance. And some of these are quite logical, right? Would you buy, on average, a stock that trades at a lower multiple over the much longer term? It's probably a better entry point than buying a stock that trades at 100 times PE. That doesn't mean that it's going to do that every month, every quarter, every year, what have you. So I do think, to your question, the industry sort of just kind of ebbs and flows from where there's opportunities.
So I didn't know that it was the 70s and that it was Wells Fargo. The first iteration, I remember, they were called Webs. And wasn't that kind of the precursor to the Spider concept at State Street?
Yeah. So then kind of fast forward to the late 80s. That's actually when ETFs were first started being created and thought about. And a lot of it came from the 1987 Black Monday crash, where investors or traders more so at the time didn't have a great way to sort of either what the term they would call is kind of lay off risk, is just sort of buy something in a basket. And so folks at the American Stock Exchange at the time tried to figure out how do we create sort of an index that can trade as like a stock. So someone could just buy the market with the push of a button. And then 1993, that's when the first ETF came to market. And then, there was a lot of early innovation happening, which, now we wouldn't even think of it as innovative, but, the webs were country specific ETFs. The select sectors came to market, and other ETFs that were providing kind of slices and dices of the market, but with the same idea: how can someone or how can anyone be able to sort of access a broader basket with one trade? And that's, I think, again, at this point, we take for granted on a daily basis that all of that work that was done decades ago now allow investors to do that. And of course, the ETF market has totally innovated since then. There's single stock ETFs, there's single stock leveraged ETF, there's outcome-oriented ETFs, things providing income, covered calls, buffers. So that structure and the resiliency that actually was intended to create, still, I think, has really propelled the ETF industry higher, coupled with all the benefits that ETF has, like the liquidity, tax efficiency, and really the tradability that they offer.
Well, thanks for the history lesson. And that's exactly why we like to have product experts like yourself on the show. But I think we're going naturally in the direction of portfolio construction. And that's what we do every day here. So maybe we can talk a bit about that. Let's talk about 60-40. Okay. So if you had to replace, the classic 60-40 sleeve, 60% stocks, 40% bonds with ETFs only, what's the smarter framework for today, given all the changes and the innovations that we've been talking about?
Yeah, I think and I'd be curious your thoughts on this, right? The 60-40 has been pronounced dead more times than I could count or remember. And a year like 2022 was probably a good reason to pronounce it dead. But then, of course, it didn't die. It came back to life. But to kind of more directly answer the question, an investor or an allocator like you all could on one hand you could do it with two ETFs, but also that's kind of missing a lot, meaning just a stock ETF and a bond ETF. But you could build a portfolio at a relatively low cost and have an allocation to commodities, an allocation to gold, if appropriate, allocation to Bitcoin and crypto and other things, all in the ETF wrapper, to kind of then fit that portfolio, let alone even on the equity side, where you could have broad-based US beta, international beta, emerging markets beta, coupled with using ETFs for a particular industry or theme, that may be opportunistic. So I think, to me, when I think about the 60-40, it's not necessarily just simply from what is the outcome going to be from a return relative to volatility perspective, but also what tools are going to be used or instruments going to be used to implement sort of the best possible outcome to still kind of consistently be able to deliver whatever the appropriate risk profile is for an investor.
Yeah, well, so I think the results last year and initially so far this year kind of speak for themselves, and diversification has been working. So I tend to agree. And as far as we're concerned, we and ETFs are involved. We use a core satellite approach, and which I think you were basically just describing, and a tactical overlay. We're multidisciplinarians, so we kind of have all the arrows in our our quiver, and they're all appropriate. They just don't necessarily all work at the same time, and that's entirely the point of diversification. Does that sound about right to you?
Yeah, well, but I think it's almost, on one hand, it's a good thing. On the other hand, it's unfortunate, right? We saw this massive outperformance of just simply U.S. large cap, right? Small caps were left behind, emerging markets, international were left behind. So people started questioning diversification, particularly heading into last year. Well, to your point, guess what? Diversification has now turned out to help a lot. So you can't always look in the rear view mirror about saying, oh man, I wish I didn't have any international in my portfolio. I would be up even more because the S&P was up even more. But you got to kind of also think forward looking. Is that environment that we find ourselves in going to sustain? And 2026 especially is a good wake up call for why investors, and diversification really matters. But also to your point of particularly having someone at the helm with being able to assist and make sort of more tactical thematic calls, because the opportunities are really, really large right now from that point of view.
Yeah. Well, so I would just pause and talk about my personal evolution from the sell side to the buy side, and from a market strategist to now actually running money and being involved in that process. I used to make these big directional calls, and everything had to kind of move in the same way. And of course, you can't run money that way, as we're discussing, because the chance of something going wrong with that kind of approach is enormous. And so, you have to be careful and kind of hedge your bets. And now and this is the training, right? Now we're very kind of probabilistic, scenario-based thinkers, which I think is the way to be when you're a kind of careful allocator and steward of capital. But I wanted to pivot a bit, and I want to talk about business, because this is such a rich discussion. We can go in any direction here, but I know what Jimmy Lee, my boss, would say. He's our founder. But in your view, what do you think separates an ETF issuer like Roundhill that wins shelf space with RIAs like the Wealth Consulting Group from those that don't? What's the special sauce?
Yeah, and maybe I'll make a bit of a shameless plug for Roundhill, but obviously I'm very biased and I love running the firm. To me, what we're seeing across the industry, and I don't think this is a surprise to people, is the big three: your BlackRocks, your State Street, your Vanguards, and then others. They dominate the market. $1 trillion firms, numbers that I think were unfathomable to investors of how much money these asset managers actually manage. But at the same time, there's been so much innovation that's now just kind of bubbling up. And at Roundhill, that's kind of our ethos. The firm was founded in 2018, with the idea of creating an ETF issuer that was really kind of product first, kind of building the right products that have long-term durability, but also kind of meet a particular objective. And so, when I joined 3 years ago, we really wanted to amplify that. So, we have thematic equity ETFs for investors who want to express particular views on themes that they may believe in. Of course, the Magnificent Seven is our flagship ETF. But even doing that, which is, I think, somewhat shocking to people, we're the only Magnificent Seven ETF in the market. Because there's a structuring issue that needed to be solved, which we did, that allows us to actually deliver that precise outcome to investors. And then now we also offer income-oriented strategies, so covered call strategies and the like, to allow people to express particular views on what they're intending to do. So and I think that's what really sets it apart for us. We want to create products that meet a particular need for investors. We do not have a traditional distribution team. We do not have a traditional kind of marketing approach. It's really sort of a one-to-many, but that only works when you have products, and not all of them are going to be outperforming at the same time, which is also the point of building a diversified portfolio from a business standpoint. But if it says generative AI on the tin, it's a basket of generative AI stocks. If it says humanoid robotics, that's it. What I call is, it's not a lot of filler in those portfolios. So it allows someone to allocate to it and say, I know that this is really going to be those 30 to 50 names, what have you, that are truly exposed to that theme. In the case of an income-oriented fund, it just does a covered call on the Magnificent Seven on a weekly basis. But that's the objective of the particular strategy. And so that's really where we start, kind of thinking about the end investor and the outcome that they may want in mind first.
You kind of mentioned a couple of the largest providers, which everybody knows, like BlackRock and Vanguard, which we currently generally don't use. We can, but we currently don't really use them. And I guess what I'm hearing from you, and I agree with, is it's the innovation, it's the niche. How are the providers like Roundhill differentiating themselves? And it's the innovation. In fact, at Exchange, you gave me a ball cap. It was meme. That's the ticker. Talk to us a bit about that. What is meme, and how can advisors use it in their practices and their models?
Yeah, so I'll acknowledge, I think sometimes, meme stocks get a bit of a bad rap, maybe for good reason. But really, why we created the meme stock ETF was intentional. And the intention was that actually, if you look at the research, retail investors before COVID on a daily basis made up maybe at best 8 to 10% of US equity trading volume. They now make up, on average, somewhere between 20 to 25%. There's been a big change in the industry where it used to just be dominated by your largest institutional investors who were acting as the price setters for particular stocks. But the idea of creating meme, and again, this would be used as a satellite. I wouldn't advocate someone sort of putting the entire portion of their portfolio in something, is to capture something like that, to capture the 20 to 25 stocks that have the most outsized influence by retail investors. They inherently are going to have higher volatility, but that means the potential for higher upside. Of course, in a down market, you're going to maybe see it on the other side. But the way we see people use it is just that kind of a small portion of the portfolio. They don't want to try to pick the next GameStop or AMC themselves. I think that's pretty difficult to do. So we use quantitative screens. Whether it's coming from more traditional metrics or also from social sentiment, to then create that basket of stocks to say, these are the meme stocks today, and they're going to change. And so for someone who wants to introduce a bit of a narrow sleeve to some higher beta names, but also with the belief that US retail investors do play an outsized influence in the markets, and we've seen this time and time again, whether it was the original meme craze in the COVID period or most recently with a company like Open Door, they can play an outsized role in setting the price of securities, and this ETF allows someone to participate in that.
Well, that's fascinating. Thanks for walking us through that and for everything that you do in the space. You were talking about fees earlier, and we're very sensitive to investment management expense, and that's something that we try to keep as low as possible in our financial engineering. And now we're offering a broad array of services. We call it scope creep. It's not just investment management anymore like it was 5-10 years ago. Now we're building in all these services for a more economical cost for our clients and investors. So it's also retirement savings, it's college savings, it's estate planning, tax planning, it's financial literacy, it's behavioral coaching, right? All these things that we offer up to clients and advisors and their practices. But I wanted to where you come into the conversation is, how do you see the fee war evolving for providers like yourselves, given the kind of increasingly complex strategies on offer?
Yeah, well, I think first and foremost, I think the idea that the importance of wealth management has only grown, especially when you see the headlines that we have, and it's not just about creating a single portfolio that an investor can use for whatever objective. It's kind of thinking much more holistically, and I know you guys are are very focused on that. But an important component of that is thinking about, well, how much is it going to cost to meet that objective, which is one of the reasons why there's been a tremendous amount of fee compression that has happened in the industry, and even continues to this day. To your point in regards to this term, the fee war, because everyone at the margin is trying to lower their expense ratio by 1 or 2 basis points so that they're the cheapest. But I do think investors are still willing, and I'd be curious to see if you agree, to pay where it's necessary, right? And so if you're talking about broad-based U.S. total market ETFs, broad-based aggregate bond ETFs, certainly you probably would be better off. Again, there's other considerations to think about, but if you're going to own it for 20, 30, 50 years, the fee compounding matters. But when it comes to sort of many of the strategies that we're doing, which are certainly higher expense ratio than other funds we have, let alone coming from some of the mega issuers, is that there actually is work being done. If you're in our covered call ETFs, we're trading options on a daily basis, selecting the strikes that are required for that, and then going out to market and trying to identify the best prices to execute that trade. So to me, that's almost a service that an investor could try to do on their own, but is worthy of paying for because it's doing something unique or difficult to do for whether it's a retail investor or a financial advisor. So to me, there's actually kind of been a bifurcation where the lowest cost indexing will continue to go towards zero. It basically has. And then there will be sort of higher fees that are acceptable to people if it's truly doing something distinct. If it's not, if it's kind of closet indexing, which is a term that people used to use a few years ago, that's where it's probably not worth paying for. If it's an active mutual fund or active manager, and at the end of the day, they just own Meta, Alphabet, Nvidia in the similar weights that you could get with the S&P 500 or NASDAQ ETF, probably not worth paying anything beyond with what you could get with the index. But if something is truly novel, to me, I think it makes sense to where that could command a higher fee for the market to not just absorb, but because they're getting a benefit.
Yeah. Well, so, I'm not just the chief market strategist at WCG. I also use my financial economics degree and skills to be a business strategist as well, and kind of do some practice management and coaching for our advisors. And that's kind of the answer to your question. If you compare where we are now, these businesses, advisors are almost like accidental business owners, right? And the industry is kind of notorious for having this 1% fee problem. It's a static fee. Meanwhile, if you look at, and this is where you put your kind of Econ 101 cap on, if you look at the producer price index for portfolio management, it has gone up 50% in 5 years. No one has raised their fee from 1% to 1.5%. Meanwhile, they're probably managing 50% or more assets, plus that scope creep I talked about. They're doing, it's not just one thing anymore. It's like 5 to 10 things. So they're diluting themselves. So it's not that the discussion about raising a fee is a penalty to their clients. It's really a business necessity, because, and this is the margin squeeze conversation that I have with our advisors. When you consider their input costs, they're not just leaving money on the table when it comes to the selling price, the revenue side, but the input costs like the tech stack and the rents and the cost of labor, they've all gone up anywhere from 10 to 33%. And so we talk about using our more efficient institutional style of money management, which is lower cost, as we were discussing, to kind of take back or recapture a big chunk of the advisor's 1% fee, giving it back to them in a kind of a stealthy way or path of least resistance to boosting their pricing power. About by 50% without that nominal fee hike. So there's a couple of ways we like to call it a twin-tailed resolution to that margin squeeze problem. But, anyway, that's kind of some of the nitty-gritty conversations that we have. But I wanted to ask you, this is more forward-looking, Dave, and talking about innovation, because that is your wheelhouse, and we can pass this along to our listeners here. What's the next wrapper? That's the word you just used, the wrapper innovation. We've been talking about, in my conversations with our CIO, Jim Warden, about some of these products. We talk about buffer ETFs. What's the next thing? We talk about defined outcome, or is it something else? What do you think?
Yeah, well, it's interesting. So, again, the ETF structure, like we've been talking about, historically was just used for indexing, right? Just give me 500 securities, thousands of securities in one ticker. Well, since then, that's of course changed. And what we've seen, particularly actually, and I think this is kind of not as well known, for years, ETFs existed sort of as a side industry, because there wasn't, from the regulatory environment, from effectively the SEC, sort of a framework for what was truly an ETF versus what was not. And that came a few years ago. There were some rules put in place that created sort of generic standards for what could be an ETF. But then a few years after that, there was then some standards put around the use of derivatives in ETFs. But as those two things have come together, it's allowed ETF issuers, like a Roundhill and others who understand the rules, to then create some really unique things that could be used in an ETF wrapper. So with defined outcome, those ETFs went after the structured note market, which is may have some utility for investors, but generally very, very expensive for most to have a particular kind of buffered outcome. So smart people put together ETFs to meet that. We did that with our covered call ETFs, or zero DTE covered call ETFs, to say, hey, that's actually an emerging instrument, zero DTE options, so meaning options that expire on the same day they're listed. Could we take a traditional covered call strategy and actually do that with zero DTE options, which actually have higher volatility, allow us to have earn greater premiums for investors? And we did the work and figured it out and have successfully been managing those funds for a few years. So to me, all of that is then kind of setting the stage for the future. And so the future to me is continued use of outcome-oriented ETFs, whether it's to buffer downside, amplify exposure, generate greater levels of income. But at the same time, I think, the industry continues to create kind of, new strategies that still are using individual securities. A few weeks ago, and the timing seems to be pretty good on this one, so sometimes it's better to be lucky than good, we launched a space-focused ETF. And so this is actually an actively managed ETF. The ticker is Mars.
Mars, I love it.
Yeah, that focuses on companies that are in the space industry. And of course, we know the SpaceX IPO is now rumored to be coming sooner than later. And that's a theme that has a lot of real world applications. All the images we see, of the Strait of Hormuz, as we were talking about earlier, those are coming from space companies. They're coming from satellites. And the connectivity that you have on your cell phone, it's coming from space. It's coming from satellites. And so I also think there's pockets of innovation that are happening in more traditional areas too, that investors, even though they might not get as much attention as what's happening with the use of derivatives in ETFs, that are still pretty exciting.
So, we're coming up to the top of the hour here. I want to give you the last word, Dave. So maybe we talked about the future, what could come, and that was a nice, well-rounded answer. But what's a category that you think may not exist in 5 years? And please, like take liberty and land the plane on something that we haven't discussed.
Yeah, I think the interesting thing is we talked a little bit about smart beta. That's actually been, I think, there certainly will still be probably assets there, but it does seem to be getting squeezed from an industry perspective, because now we also have the ability to do true active ETFs. And we're seeing that from more traditional mutual fund companies taking their strategies that were very proprietary. ETFs are transparent, right? So it was kind of logical. If you remember back at our time at Oppenheimer funds, there are certain PMs that didn't want their holdings to be known because they were really important to them, and that's where their secret sauce came from. But that's all changed because the vehicle has a lot of benefits. And so the sort of in-between areas, and I think there's still a lot of benefits for factor investing over the long term, quantitative models, things of that nature. That's my background. That's your background in a lot of ways. But sort of an ETF that kind of fits in the middle, maybe it's 50 basis points, and it's doing something a little bit different, but maybe not enough. And it's more expensive than what the actual index is doing. That's probably where we'll start spending a lot less time talking about. For various reasons, we saw the same thing with ESG type strategies, which were all the rage, a few years ago. You don't hear as much talk about it. You don't see as many launches, of course, in that space. Again, that has kind of different reasons for why that's the case. But I think this sort of middle ground is probably where we might see some squeezes because, investors, particularly when thinking about broad-based asset allocation, are going to want to I know this is effectively how you guys think about portfolios, looking at sort of, core exposures in a low-cost beta way, couple that with satellites on either the true active side or a theme or a sector or industry that's going to add, some resiliency or outperformance in a portfolio.
Well, Dave, this has been a very efficient way for us to catch up. And publicly, I want to thank you for, being such a gracious guest. And if you do something like this, please have us on as well. Here's Three's company too. Come and dance on our floor. Take a step that is new.